Hi, this is Tron Welch with the fourth quarter 2023 economic update. We'll admit this one will be a little bit longer, but we got some great content. I was in Philadelphia last week at the Schwab conference and had access to the biggest and best minds in the investment world and the economic world. So, from there, I take the ideas, think about them, throw out the ones that I just think are a little bit of witchcraft, and then hang on to the ones that have some validity that I can actually see happening. And that kind of gets boiled down today. We are using a fair amount of the JP Morgan slides. It just encapsulates and does a good job at capturing it. So from there, let's start with the economic growth and composite GDP, the same slide that I show you every time. And what is interesting is that last quarter, it just came out last week, that the third quarter 2023 growth of the economy was 4.9% year over year, which startled everybody and I think was a big surprise. I think it was disappointing for folks that are trying to slow the economy to hold down inflation, but there it is. The economy continues to be resilient and strong, even though the federal government is trying to put some dampers on it to keep inflation under control. However, inflation is doing pretty well, and you'll see that in just a minute anyways. So moving over to corporate earnings, this is kind of infringing on the investment side of things, but just to let you know that projected corporate earnings moving forward look pretty good. On a year-to-date basis, 2023, the growth in earnings has been through increased margin. So they're making more money on the things that we buy. We're not necessarily buying more. Revenue is generally flat, but they're making a little bit more money on each item we buy. All right, recession determinants, which I think is one of the big, why you're listening to this thing. So on the front end, we don't see a recession coming. I've said that for a long time, even though there has been a lot of recession fears over the last 3, 6, 9, and 12 months. I never really felt that the recession was going to come, and you're more than welcome to look at the prior videos of this to hold me accountable that I've never been convinced that a recession is going to happen. And really what drives that is the next slide of the labor demand. And when I just look at it, it's the left-hand side chart that is compelling to me, and it's the JOLTS, which is the job openings report. And we can see that at the peak of March of 2022, there was 12 million open jobs in the U.S. And that is down 2.5 million jobs, but it's still 9.5 million job openings. And that just tells me no one has been able to present a viable argument to me how we're going to have 9.5 million open jobs and enter a recession. Because keep in mind, that's 9.5 million jobs that a company is trying to hire in order to increase their revenue or reduce their expenses, or they're feeling they're able to make more money and be better off by adding people to it. And that certainly doesn't sound like economic strife to me. Now, if the JOLTS report, maybe gets down to the, 4 million type jobs, then I'd be a little bit more concerned about a recession. But until then, I'm saying no recession for whatever that's worth. Now, the things that do concern me are the federal finances. And the things that are happening here are just, I think we really need to think about this. So on the left-hand side, the first bar chart is the amount of money that we're spending, and that's 6.2 trillion. And, it's really not, so that's part of the equation. The other part of the equation is where is that money coming from? So the taxes that we're collecting only cover about 75% of our expenditures. And then that big borrowing number that's in the dotted lines, we're basically borrowing 25 cents of every dollar that the federal government is spending. So I just that just doesn't feel sustainable to me. And what's concerning to me is I'm not hearing anybody in the political realm talking about the deficit in any real serious manner. We're not talking about reducing spending, and we're not talking about increasing taxes. Both of those would have the ability to reduce the deficit. And just mainline politicians just aren't talking about it, and I think it's a discussion that we should bring on. On the right-hand side of this, down at the bottom, the federal net debt. And really, this is as a percentage of GDP. And the deficit against the GDP is basically almost on terror from below 40%, which if we go back to 2004, we would have all said the deficit was too high, but we were just getting started. So between 2004 to today, the deficit has just been on a straight uphill terror of increasing, and now we're at 118% of our GDP in 2033. That is just a forward number. Today, we're at 98%. We're basically, for every dollar of economic product we have a dollar of debt. And that just doesn't feel sustainable to me. But the other thing that's happening is now that interest rates have increased, the cost of borrowing for the federal government has significantly increased. And if we look at this next chart, this is net interest costs. And you can see clearly going from the gray to the blue, the big step up is somewhat of the deficit, but a large part of it is the increased interest rates that we're now having to pay on the debt that we have as a country. And then this is kind of assuming that interest rates stay basically the same, and up we go to, in 2053, 35% or 1/3 of our budget will be interest costs, which would be the largest line item that there is in the federal deficit. And you wouldn't run your household with the largest expense being interest, and I'm not really sure that we should run our federal government that way either. So I'm really interested in hearing about some solutions on controlling the deficit and making sure that we just don't saddle our kids and grandkids with just an economic disaster that we could have addressed, but we just chose not to. So from there, let's move on to the bank assets and liabilities. And the slide that I want to talk about here is really the left side here. And the left side bar chart is the 25 largest banks. And you can see their commercial real estate is 13% of their loan portfolio. Okay. And that is stark contrast to basically the banks, all the banks outside of the top 25%. And they're holding 44% of their portfolio is in commercial real estate. And so you're going to see that they're going to have to manage that much better. And we had some bank failures earlier in the year. The bank failures were caused by inappropriate investments that they made, that when interest rates went up, they kind of got caught with their hand in the cookie jar. And so that was that problem. But now there's some rumblings of, wait, what about commercial real estate? And that would hurt the smaller banks significantly more than the larger banks. But I'm not quite sold on this. And part of that is this next slide, which on the left-hand side is the U.S. real estate cap rate spreads. Bunch of words there. Let's talk about what that really means. All the way in June 23, so a couple months old, there was a 1.2% spread in cap rates, which basically means that you could make 1.2 more in real estate than what you made in the 10-year treasury by the U.S. government. So investing in U.S. treasury bonds is considered the safest investment on earth. So you can go from the safest investment on earth to something pretty volatile currently like real estate and get a 1% help on that. The 10-year treasury is paying a little bit over 4, but you can then go into real estate and get a little over 5. And I think we're all understanding that is a significantly different risk profile. So, I think we're going to see a little bit of pause in real estate investing. Now, all this would unravel if, as loans are coming due over the next 2-3 years, these companies are not able to refinance the commercial debt at lower interest rates. So maybe they're going to have to re-sign, just like 30-year mortgage rate right now is just a shy under 8%. If they're taking a commercial loan that was maybe at 4 and now they're having to turn around and pay 7 or 8 or 9 on that is a material difference to their cost structure, and that would be the unraveling of commercial real estate if it comes to bear. On the right-hand side of this is the vacancy rates, and I think this is important to kind of go through. So let's start from the good to the bad. On the good side, depending on what you view, industrial real estate has extremely low vacancy rates, and so I would expect there to be a little bit of a boom of industrial space being created for these companies, to house all the companies that are looking for space. One up from there is apartment buildings, been fairly steady. Vacancy rates popped a little bit in COVID and now are back down to where they've been over the last 10 years historically. Then the big movers are retail. And you can see the retail, this is like, are you sure number? So retail vacancy rate is actually declining, which doesn't make sense to anybody. I think if we asked 100 people on the street, everybody would say that retail vacancies would go up. Why is it going down? Well, we're seeing real estate being converted. Starting here in Boulder, the old-time Boulderites would remember Macy's or May DNF before that. I think it was Foley's before that. But anyways, Macy's got destroyed or taken down out of 29th Street Mall, which we would call Crossroads Mall. But anyways, and it got replaced by office space. So it wasn't that necessarily retail space, more people rented it. Just they took some retail space offline, and so maybe the same amount of retail space is rented, but less is available, which is causing the retail space to go down. And then the big one, which I think is the interesting piece here, is office space. Now in Boulder, they just built, the example that I just gave you, they built Class A space on the Macy's land. That's an easy tenant find in Boulder, Colorado. Maybe not in other parts of the country. So maybe other parts of the country, they're taking out retail and putting in apartments or something like that. They're solving it that way. So I think office space is a little bit of the soft underbelly of the commercial real estate, and we'll see, between people not coming back to the office, people needing less office space, and then the struggle of building owners to get their commercial office space refinanced at higher rates 2 or 3 years from now. That would be kind of the pinch that might unravel the office space section of the commercial real estate market. Okay, which means that certainly not a majority of the commercial real estate loans would be a problem, but there could be. That would be if we do have a commercial real estate unraveling. That's the scenario that it would take place at. So let's now go to you and I and the consumer finances. On the left-hand side is consumer balance sheet. We continue to be strong. Our debts are in place. We're building wealth, and we're doing just fine. On the right-hand side, you can see even though we're doing fine, it's certainly softening. So household debt service ratio, you can see that kind of pop back up. And so this is people buying new homes at an 8% 30-year mortgage. That is obviously a big heft of debt service that they've got to take place on. And so that is popping up, but is still, basically on average from 2010 and, basically half of what it's averaged from 1980 to 2010. So the debt service ratio is really looking pretty good over a long period of time, even though it's spiking up. And then below that, kind of the same concept where we are seeing delinquencies in lending on the auto and credit card. Delinquencies are definitely upticking in there. They're still kind of below or at historical averages, so it's not like new territory, but this should show that the household consumer is starting to weaken and soften a little bit, and that should help with the inflation piece. The next of the consumer saving and borrowing is kind of the additional evidence of the consumer is softening a little bit. On the left-hand side, you can see personal savings rate is down to 5%, which is a really low amount, and nobody's going to get to retirement at saving 5%. On the right-hand side, the household excess savings, which is that blue shaded area, you can see where people just had, basically $2.3 trillion sitting in bank accounts, and now we're whittling through that. Spending it on travel and mostly large luxury goods, and now that is down to 1.2 trillion. So a lot of the stimulus that has taken place, we've kind of eaten through half of that. People are kind of hitting the brakes a little bit, and some households are feeling the pinch and the tightness between the inflation and in raising interest rates. It's taking up their extra income. Speaking on inflation, there's still At the federal government level, a lot of angst about inflation. We are now sitting below the average since 1973. So to say it's high inflationary period wouldn't necessarily be accurate over that historical time, but it would be higher than it's been since 2007, basically. But it's headed in the right direction. The Federal Reserve still feels like there's some room to grow there, and they're going to keep working on it, which we'll talk about in a minute. Next is the inflation heat map, which is just kind of supporting what I've said. It continuing, kind of moving from 2021, where you can see a lot of red on the left side. As you move across the graph to the right side, a lot of green taking place. Now, what's really kind of holding up and kind of spiking is kind of not quite the right term, but the higher points of inflation are shelter again. So this is people buying their primary homes, getting the 30-year mortgage at 8%. That's certainly an inflationary pressure on that. And then the rent of rental property, rents continue to outpace and kind of lead the way on inflation. Gas and electricity were very high in August, but that has declined. The rate of growth has declined during that time period. All right, federal interest rates. This chart is showing that the market, the Fed Reserve, and the basic bond market believes that interest rates will decline, basically starting today and declining moving forward. And I was talking to a bond investor, and he basically said that they've been, that interest rates will go down, starting from a month or two from now, and then decline down, quite a bit. And then he said, I've been saying the same thing for 3 years, which is just, it kind of highlights how we all get together, come to these grand conclusions, and then it just doesn't work out. Inflation was certainly more sticky than transitory. Remember that word? Inflation's transitory. Well, it was not. It was very sticky on day one there, and inflation has continued much longer and stronger than any economic professionals felt it would. But anyways, maybe this time we really are at a spot that the interest rates will decline, and that will help us. That will help our returns. We should see a little bit of lift in the stock market, and certainly some lift in the bond market is that case. Which brings us to fixed income. And there's a couple of things here. This is kind of sliding into the investment side, but this is really important that it's kind of worth saying twice. So on the right-hand side, it shows the impact of a 1% rise or fall of interest rates. If we took this chart from a year ago, you would see a much different scenario to where, like the 10-year Treasury, if the interest rates went up 1%, you would have a material loss in your bond. It would be a bigger negative number than a 1% fall in interest rates. Would help a little bit, but not a lot. The 10-year Treasury basically sitting at a smidge under 5%. That has all changed. So now the 10-year Treasury, if interest rates fall 1%, we'd pick up close to 13% of value in there. Great. Anytime we can clip a coupon at 13, we're pretty happy to do that. But if interest rates, went up, we'd only be in the whole 3%. So it's kind of interest rates going up or down. If they go up, we're going to lose 3, and if they go down, we're going to pick up 12. That's kind of the odds that we're looking for as bond investors. So we are investing in the bonds. First time in my 22-year history being a financial advisor, we have a bond sleeve in portfolios. Whew. Getting close to the end, the yield curve. This is an inverted yield curve, and that's the line up at the top. And you can see rates are higher on the short term than they are the long term, which makes no sense whatsoever, because it's certainly more risky to lend people money over a 30-year period than over a 3-month period. But that's not how interest rates are pricing right now. The inverted yield curve is supposed to signal a recession. I don't think that's ever true. I've never heard a good argument what actually causes that. It almost sounds like it's more of a coincidence type piece. But anyways, if anybody wants to put forth a good, strong argument of why it happens, stronger than 6 out of the last 10 inverted yield curves, so we've been in a recession, that feels like coincidence to me more than an actual argument on how it occurs. Anyways, the purpose of what I wanted to do with this slide is just to show how dramatic interest rates have moved from December 31st, which is the bottom line. Let's go with the 10-year Treasury at 1.5% December 31st, 2021. Now that's at 4.8%. I mean, we're talking about a triple or doubling of interest rates that have taken place in just 2 short years. In bond world, that is a seismic shift of probably unparalleled event of what has shifted in interest rates. That's what's causing the 11% loss in bonds last year, and then a 5-year period of zero bond returns that just recently ended. So for my investors that we just haven't been using bonds over the last 22 years. Again, we've been rewarded for taking that additional risk or staying away from bonds, but the time period has kind of shifted where now the 10-year Treasury at 5% looks kind of attractive, and we are making some investments in that area. Shifting real quick to the global economic activity heat map. I just like these things. They're super easy to look at. You kind of see the redness of 2020 and just kind of greening as we go along. Now with that, there's been a little bit of softness that we're starting to see in Europe, which isn't, and it's kind of a funny statement, but seeing some softening in the economy probably isn't really a bad thing if we want to really get inflation down. So, maybe the world economy is going to slow a little bit and help inflation slope down. On global inflation, this last heat map, I don't know why they switched out blue for green, but they did. And you can see a whole lot of red of high inflation during 2022, but you can certainly see it's waning, and that red is giving way to a softish pinky type spot. It's certainly not blue. So, but the world inflation or global inflation is certainly trending in the right direction. Last slide that I want to go through today is the China economy. There's a lot of news out there, and I'm trying to separate what is just kind of like clickbait and a little bit of headline grabbing that's going on in the Chinese economy. One of the figures that really struck me is on the right-hand side, the household deposits and loans. Household deposits have really increased significantly from 2020, through the pandemic. China was in pandemic quarantine, shut down much longer than the rest of the world, and cash is kind of piled up in the Chinese banks, if you will. People paid off their household loans. As you can see, the loan is kind of dropping pretty hard from 2021 on down. So the Chinese have plenty of cash. They just need to feel comfortable to go spend it. And when they go do that, we'll see some steadying of the Chinese economy, and we should be rewarded in the Chinese investments. We should be rewarded with that over time. The big elephant in the room with China is the real estate holdings in there, and it looks like they did material amount of overbuilding, and they've got a couple of real estate firms that are gigantic, of course, that have significant and material real estate issues. Chinese government is just going to have to solve that. But the collapse of that real estate sector will not sink the China consumer once they feel safe to invest. So I think the strength of the Chinese economy can overcome the real estate issues that they have there. But it's just like in the U.S. sector, which I think we're a little more comfortable with. We're talking about possibly a commercial real estate problem, and it could very well be a problem, but it's not going to sink our overall economy. So with that brings me to the rest of today. I know it's a little bit longer than usual. Thanks for sticking it out. If you have any questions or concerns, please give me a call. I'm available to talk. Have a great day, and we'll talk to you soon. Bye-bye.